Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're discussing a significant development in the Ontario real estate market, the move towards a centralized multiple listing service, MLS, as most real estate boards transition to PropTx. PropTx is a wholly owned for-profit subsidiary of the Toronto Regional Real Estate Board, and it's promising Ontario realtors access to a centralized MLS, a long-standing goal among real estate professionals. According to John DeMichel, Chief Executive Officer of the Toronto Regional Real Estate Board, the creation of PropTx has been a strategic focus, and the collaboration with participating boards and associations has been essential. DeMichel emphasizes that a unified MLS database ensures consistency and continuity as it matures. The final stages of data transition are underway, and several enhancements, such as expanded mandatory fields and integration of pre-populated external datasets, are expected in the first quarter of 2025. The participating boards include a wide range of associations from across Ontario, such as the Central Lakes Association of Realtors, the London and St. Thomas Association of Realtors, and the Ottawa Real Estate Board, among others. This move means that members of these associations will have access to more data than ever before, which is expected to expand as new features are introduced. DeMichel highlights that this shift creates efficiencies for realtors, both in business operations and cost management, by reducing the need for interboarding MLS listings and multiple memberships. However, this transition marks a shift for the Information Technology Systems of Ontario, ITSO, a not-for-profit corporation created in 2020 to increase access to MLS data. With many boards moving to PropTx, ITSO's initial purpose may no longer be relevant. Jeff Halford, ITSO Chair, notes that member boards such as the Kingston and Area Real Estate Association and the Niagara Association of Realtors have already left ITSO in favor of PropTx. While ITSO remains committed to supporting its remaining member associations, Halford acknowledges the changing landscape and its potential impact on the organization. Paul Chan, president of the Ottawa Real Estate Board, supports the move to PropTx, noting that the new platform promises a better experience with more readily available data, faster communication, and smoother transactions. He believes that PropTx will bring stability and consistency to the industry, ensuring that realtors have access to quality data across regions. It's clear that the move towards a centralized MLS database is a significant development in Ontario's real estate market. While it promises many benefits, it's important to keep an eye on how these changes impact various stakeholders, including ITSO and its remaining member associations. As always, we'll continue to monitor these developments and keep you informed. Today's focus is on the recent inflation report and what it means for the Bank of Canada's upcoming interest rate decision. Canada's inflation rate dropped to 1.8% in December, marking the lowest level since February 2021. This decline has increased speculation among economists about the possibility of a rate cut by the Bank of Canada. The December Consumer Price Index report indicates a slowdown in inflation, partly influenced by the federal government's temporary goods and services tax and harmonized sales tax holiday, which began on December 14th and is set to last through January. However, the Bank of Canada's preferred core inflation measures have shown an increase on a 3-month average basis, remaining above the bank's neutral target range. Looking at the numbers, the headline Consumer Price Index was 1.9% in November and eased to 1.8% in December. Core measures like the Consumer Price Index median and Consumer Price Index trim also saw slight reductions, though they still reflect higher rates than the overall headline figures. Shelter costs, including rent and mortgage interest, continue to exert pressure, with mortgage interest costs showing a notable decline from 13.2% in November to 11.7% in December, yet remaining a significant part of year-over-year growth. Economists have varied opinions on the implications of these figures. Scotiabank highlights that core inflation remains elevated, posing challenges to the Bank of Canada's 2% target. National Bank economists note that excluding indirect taxes, inflation saw its largest monthly increase since 2007, reinforcing concerns about core inflation. Meanwhile, CIBC warns that the full impact of the tax holiday will further complicate inflation readings in January. On the subject of mortgage interest costs, economists from the Royal Bank of Canada observe a slowing growth as previous rate cuts begin to influence borrowing costs. However, mortgage interest still accounts for a significant portion of the consumer price index growth, approximately 30% as of December. As we look ahead to next week's Bank of Canada rate decision, economists are split. TD suggests that the recent uptick in core inflation pressures might lead to a more cautious approach to rate cuts, expecting a quarter-point reduction at every alternate decision this year. BMO, on the other hand, cites trade uncertainties as a major influence, leaning towards a rate cut for risk management. CIBC believes that the current economic conditions justify a 25 basis point cut, while Scotiabank remains skeptical, questioning the need for further cuts given past reductions. Desjardins and National Bank both anticipate a 25 basis point cut, pointing to ongoing economic uncertainties, including potential trade tariffs. These perspectives highlight the complexities facing the Bank of Canada as it balances inflation control with economic growth amidst a backdrop of global uncertainties. Canada's escalating housing crisis and ongoing supply challenges have led to increased focus on the development of secondary suites on existing properties. Last week marked a significant step in this direction with the introduction of a new insured mortgage refinancing product by the government to encourage such construction. This initiative, first announced in last year's federal budget, is designed to spur the creation of additional housing units by allowing property owners to secure a loan-to-value ratio of up to 90% of the property's value for adding more units to their homes. The Canada Mortgage and Housing Corporation, CMHC, has set out specific conditions for this new product. Borrowers or a close relative must already occupy one of the existing units, and any additional units built must not be used as short-term rentals. Furthermore, the property must not exceed 4 dwelling units in total, including the existing one, and the as-improved property value must remain under $2 million. This policy, effective as of January 15th, aims to promote densification and address the slow pace of home building across the country. With housing starts increasing by only 2% last year compared to 2023, according to the latest CMHC data, there's a pressing need for more housing development. The pace of 245,120 units constructed last year falls significantly short of what's required to restore affordability by 2030. The construction of laneway homes is gaining traction in major cities and more expensive markets. Anthony Zhang, a mortgage broker based in Vancouver, reports that many borrowers are considering adding units to their properties as a strategy to manage rising mortgage costs. Zhang notes that some clients are contemplating refinancing or seeking other financing options to build a laneway house, thereby generating rental income to help with mortgage payments. In some cases, high mortgage payments are prompting homeowners to alter their house layouts to increase rental income. British Columbia's recent crackdown on the use of non-primary residences as Airbnb units has led some Vancouver homeowners to renovate their main properties to accommodate short-term rentals legally. By ensuring their homes remain primary residences, these homeowners can legally convert parts of their properties into Airbnb units to boost income, thereby preparing for high mortgage payments. Despite recent reductions in mortgage rates due to Bank of Canada rate cuts, affordability remains a significant challenge for many Canadians. The development of secondary suites presents a viable option for boosting income amidst tight budgets. Zhang highlights that many people, particularly those with variable mortgage payments, have faced substantial financial strain as their payments doubled over a few months. To cope, they have had to cut back on savings and discretionary spending. While selling a property is often seen as a last resort, downsizing can be a practical solution for Canadians whose budgets are stretched by rising payments. Zhang points out that if the interest payment on a large mortgage exceeds rent, downsizing might be a sensible choice for those unable to afford their current homes. The Alberta government's commitment of $112 million aimed at constructing 250 new permanent homes in Jasper, Alberta, is currently at a standstill. The province's Social Services Minister, Jason Nixon, stated that the funding would be withdrawn if the local government and Parks Canada continue to pursue a different vision for rebuilding the town after the wildfire. The town of Jasper is advocating for multi-unit buildings to address its persistent housing shortage, while the province mandates the funds be used exclusively for detached, single-family homes. Minister Nixon emphasized that if a project does not align with the province's requirements, the allocated funds cannot be utilized. With more than 600 families in Jasper displaced, the differing visions for the town's rebuilding have led to a deadlock between the provincial authorities and the municipality, which is collaborating with Parks Canada on the reconstruction efforts. Jasper officials have pointed out the limited space available for building. Under the provincial plan, only 60 of the 250 promised homes could be constructed. The town is pushing for short-term housing solutions while working towards the development of permanent high-density units, a process estimated to take 18 to 24 months. These new homes would be in addition to the insurable homes set to be rebuilt in the coming years. Michael Fark, director of the Jasper Recovery Coordination Center, expressed the town's uncertainty regarding whether the provincial government will cover the servicing costs for interim housing units, which are projected to range between $5 million and $7 million. Fark highlighted the town's financial limitations, stating that they lack the resources to absorb such costs independently. He noted that the town faces a choice between housing fewer people in more comfortable accommodations or providing for more families in less desirable temporary units, acknowledging the trade-off involved. Minister Nixon did not clarify if the funds would be redirected to other areas of Jasper's recovery if the current project does not proceed. He mentioned, "If we do not end up doing this project, it would not be utilized, but there are other areas where we would be investing in other ministers' budgets." He reiterated that the province has already invested hundreds of millions in Jasper's recovery and is prepared to continue its support. Jasper's mayor, Richard Ireland, has yet to respond to Minister Nixon's comments. Meanwhile, Alberta continues to assist in replacing seniors' facilities lost in the fire and establishing temporary facilities in the nearby town of Hinton for seniors, which Nixon confirmed will proceed regardless of the housing impasse. Jasper's ability to expand its housing options is constrained by its location within Jasper National Park, which has tightly controlled town boundaries. Any changes to these boundaries would require a new bill to be passed in Parliament, limiting the space available for new housing development. The town has historically struggled with a 0% vacancy rate, exacerbating the housing crisis. Today, we're turning our attention to a significant leadership change at Westboro Mortgage Investment Corporation, commonly known as Westboro MIC. The company recently announced that Nick Christopoulos has stepped down from his role as Chief Executive Officer, effective December 31st, 2024. This marks the end of a notable 4-year tenure, during which Christopoulos played a crucial role in steering the company's growth strategy through challenging economic times. Under Christopoulos' leadership, Westboro MIC achieved several key milestones. One of the most impressive achievements was the increase in the fund's annual compounded return on investment for F-class investors, which rose from 6.4% at the beginning of his tenure to 10.69% as of last month. This growth reflects a robust strategy that effectively navigated the complexities of the economic climate. Additionally, the company saw a significant expansion in its assets under management, growing from $230 million to $496 million. Investor equity also saw a substantial increase, rising from $177 million to $361 million. Moreover, a syndicated line of credit, led by TD Bank, was raised from $90 million to $260 million, showcasing the company's strengthened financial position under Christopoulos' tenure. Reflecting on his time with the company, Nick Christopoulos expressed gratitude for the opportunity to lead Westboro MIC during a period marked by the pandemic and subsequent rapid interest rate increases. He highlighted the accomplishments achieved by the team during these challenging times and expressed his commitment to supporting the company's future success in his continued role as a board director. Westboro MIC has expressed its gratitude for Christopoulos' contributions and leadership, noting that there are no current plans to fill the CEO position. Instead, the company seems poised to continue leveraging the strategies and frameworks established during Christopoulos' tenure to maintain its growth trajectory. Westboro Mortgage Investment Corporation is recognized as a private lender providing residential mortgage financing in Ontario. The Westboro Mortgage Investment Fund manages a portfolio of short-term residential mortgages, with more than 90% of these mortgages in the first position. This positions the company as a significant player in Ontario's residential mortgage landscape. As we wrap up today's episode, it's clear that leadership transitions like this one at Westboro MIC have the potential to shape the future of companies in the mortgage investment space. We'll continue to monitor developments within Westboro MIC and the broader industry to keep you informed. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.